following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
Welcome to the Option Block, everybody. Today I am your host, Mike Tusaw, filling in for Mark Longo. And before we get started, let's introduce our cast of characters. From the Option Pit, we have Mr. Andrew Giovinazzi. Andrew, how are you today out in the great state of Maine?
I am doing well. Spring is sprung. We're fully springing now.
Fully spring. That's good. Yeah, it's beautiful out here in the Chicago area today, but the problem is that the temperature is really not isn't quite as attractive as the skies look today. Next, we have coming in from Options Express, the man, the myth, the legend, the viceroy himself, Mr. Alex Jacobson. Alex, how are you today?
Good. Little light volume day, but a couple things popped up today, so a little bit to talk about, but all good. And it was actually snowing in Deerfield this morning, but it was not sticking. So to your point, it's still cold here, but hopefully we're at the tail end.
Got it. And also later on in the show, we have a couple of things that we're excited about. We're going to have Matt Bradbard, one of my fellow brethren from RCM. He's on the futures desk. He'll be talking to us about the Eurodollar futures and some of his thoughts on that. And then the other thing, Apple actually just announced a news bulletin. I just had come across my screen that they are actually, I'm not able to see what it is, but Apple's actually down about $2.20 a share right now in post-market trading. So we'll have to investigate that a little bit as things go on. I'm not sure what that is.
The Interview Block.
And welcome to the Interview Block, everybody. This is the section of our show where we get someone to come on, and as per your request, we will talk about whatever topic is happening in the marketplace. And today we have a pretty interesting guest. He is actually a futures broker from RCM, our firm, and what he wants to talk to us about today, or what we brought him on the show to talk about, are interest rates. It's a hot topic these days in terms of our interest rates. What are they going to do? Now, we hear the Fed Chairman Bernanke talking about how he's going to keep interest rates the same for a couple of years. We see historically it's really not possible for the Fed to lower interest rates any more than they are. And politicians want to be reelected, and I know that Bernanke is not technically an elected official, but still, I don't think it would look good for him right now if he were to raise interest rates today. But ultimately, there's a lot of talk about that, and so today we brought on our show Mr. Matt Bradbard. Matt, welcome to the show.
Glad to be here.
That is good. So, Matt, tell us a little bit about some of your thoughts on interest rates in general. I know you wanted to talk a little bit about a Eurodollar trade, or a little bit about the Eurodollar specifically, but in general, maybe tell us a little bit about the interest rate environment and some of the things that you're seeing right now.
Yeah, certainly. It's a really unique situation, and ultimately, I don't think interest rates are going to stay at these levels for an extended period. We've been, effectively at zero for the last 4 years. I'm not smart enough to know the catalyst to get us moving higher, but eventually, I do think that either the economy domestically will improve, or the reckless monetary stimulus will fuel inflation, and then the Fed's the Fed's hand will be forced, and we'll have to raise at that point. If we take a step back and look at the big picture, we had a cycle for about 25 years from the late 50s to the early 80s where interest rates went up. And then we reversed course, and from the early 80s to 2009, rates for almost 30 years went down. And as I said, Mike, we've been constant for about 4 years. What I'm doing and what I'm advising to some of my customers is to be a couple years out with a window, 2 to 3 years out, speculating on interest rates moving higher within that time frame.
Got it. So with that, the concept is you're not necessarily looking for an interest rate spike tomorrow or 2 or 3 months from now. It's more of a long-term thought that you have in terms of interest rates going to the upside.
Correct. And, what I have advised my clients to do, as opposed to playing the long end of the curve, everybody talks about playing 30-year bonds and there being a bond bubble. I'd prefer to play, the short end of the curve, i.e., the Eurodollar. And what makes it a unique contract, in my opinion, is, if you compare apples to apples in terms of what a Eurodollar contract, what the risk is, what the upside, what the cost of the trade is versus, 30-year bonds in my market, trading futures, you need roughly $3,400 of initial margin to trade one 30-year bond contract with a face value of $100,000. For the Eurodollar, the initial margin for one futures contract, which has a face value of $1 million, is $675. So
now let's expand
pound,
on that. Let's expand on that a little bit. Sorry to interrupt, but let's expand on that a little bit. So in terms of the 30-year bond, for a lot of our listeners out there, they're very familiar with like TLT or IEF or some of the ETFs that cover some of the longer-term bonds. Maybe to give them an idea of it, explain a little bit like what is the 30-year bond futures based on, and then maybe tell us a little bit about what the Eurodollar future is based upon.
Yeah, certainly.
Get into that.
I mean, I can give them an idea in terms of the you're talking what the face value is, where the 30-year bond is, where the Eurodollar is, and how I would construct a trade, in 30-year bonds versus Eurodollars. Is that what we're chatting about?
Well, I guess before we even get to that, maybe explain to a little bit like what is the Eurodollar, because just to make sure in terms of, because we do have some beginners out there, maybe to
absolutely
clarify, it's not the euro currency, it's the interest rate. Maybe kind of take a step back on that, if you would.
Absolutely. I'm glad you brought that up, because a lot of the times when I say Eurodollar to an existing or prospective client, even somebody that's traded commodities in the past, they think it's a currency play, and they talk about the euro currency, and it's nothing to do with the euro currency. All Eurodollars are simply bank deposits denominated in U.S. dollars held in foreign banks. Okay, consequently, because it's outside the jurisdiction of the Federal Reserve, the deposits are subject to less regulation than similar deposits here within the U.S. So essentially what we're looking at here is it's $1 million face value. Each contract has a 3-month maturity. So in dollar terms, the contract size, Mike's $250,000. There's 4 futures contracts that trade: March Eurodollars, June, September, and December. What makes it attractive to me, and I know I alluded to this a little, is the cost and margin is about 20% compared to 30-year bonds. Another attractive thing to a trader is we can go 2 years out, 3 years out, and there's a market. It's extremely deep. It's extremely liquid. And, if you were to put a play on in 30-year bonds, there's no market in 30-year bonds, 2 years out.
Got it. Now, with that, what are some of the ways with which you're advising from a general level, not to get too specific, but just from a general level, what are some strategies with which you're advising clients to do in terms of, are you advising maybe selling premium, perhaps buying options, or perhaps just taking a side, or just being straight short the Eurodollar future contract? What are some of the trades with which you're advising at this point to your clients?
I think there's three different ways you could approach this. You could go outright just short a futures contract if you're comfortable, which most of my clients are. You could sell premium. You could sell calls looking to play a bearish move that way, or probably the most attractive option to a lot of your listeners is just buying options. And before I just prior to getting on this call, I priced out a couple different scenarios where you could buy. The December 2015 futures is trading at 99.10. Okay, you could buy a 99 put, which is just out of the money by 10 ticks. Every tick represents about $25 in this contract. You could buy a 99 put with about 2.5 years time for under $1,000. Okay, that particular option has a 54% delta. Let's say you thought rates, as an investor, you thought within 2.5 years time, rates could be 1.5 to 2%. You could go a little bit out of the money. You could buy a 98.50 contract December 2015 for just a shave above $600. And to play out this scenario, Mike, let's say rates were to go to 2% within that time frame.
Okay.
Okay, that would price the futures at roughly 98, because how you figure this out, you take par, 100, minus wherever rates are, wherever the perception that rates are. So 100 minus 2 would put futures roughly at 98. And let's say you had a 98.50 strike, you're going to be intrinsic by 50 points or 50 ticks. Every tick, again, is $25. So you're going to be intrinsic by $1,250 for an option you paid $600 for.
Okay, now just to take one more quick step back, to clarify also, as the Eurodollar goes down, that's based upon interest rates going up. So in other words, the interest rates and the Eurodollar, interest rates themselves and the Eurodollar have an inverse relationship.
Correct. Just like any debt instrument, 30-year bonds, 10-year notes, 2 years, as rates go up or down, the underlying is going to move the exact inverse.
Got it. And just the other thing that I want to clarify for our listeners out here, if you've never heard anything on Eurodollar futures or Eurodollar options before, I can tell you it's a very big and very liquid contract. So if you've ever looked at options on like IEF, for example, there's some pretty wide bid-ask spreads on there. And the Eurodollar, that's not the case. Now, the other thing that I want to kind of add to that too is, if you're not used to ticks and points and things like that, if you're used to just kind of the common one call option equals 100 shares, and that's just kind of what's ingrained into your brain, what Matt's talking about, it's not that hard to learn. It's just kind of along the lines of, in Mexico, they call it a casa. In America, they call it a house. Learning the different language is a very easy thing to do, especially when you have someone like Matt working with you. But my point is that don't be intimidated if you don't understand it. If you just buy a call, the bottom line is this: you have limited risk. If you just buy a put, you have limited risk. So with this, if this is kind of a newer thing to you, I'd encourage you to still learn about it, because the Eurodollar future is a pretty big question. And now, Matt, we do have a question from Andrew. Andrew,
hey, hello, Matt. How are you?
Good, and yourself?
I'm doing well. So can you talk a little bit about what's happened to, let's say, the volatility in the Eurodollars? Actually, we had a guest come on the Option Pit about in the fall, talking about kind of the same subject, where you've had like this low interest rate environment and a low volatility to the interest rate environment. So it sounds like there's a lot of leverage for the dollar going out to 2015. Is it because the volatility really is so low and the expectations for interest rates aren't changing, to a great extent? Could you speak a little bit about that?
Yeah, I can speak about it on two different fronts. One, in terms of the movement in the underlying futures contract, it has not necessarily dried up, but in terms of the ranges, they've certainly shrunk in the last couple quarters. And you hit the nail on the head in terms of the perception shifting, where the market's priced in that rates are going to be at the current price, not any higher or lower over the next 1 to 2 calendar years. So you've literally seen in the contract that I'm trading for clients, predominantly December 15, the range has been roughly 35, 40 ticks. So, you have, call it 40 ticks, trading range of $1,000 on a futures contract. And again, the margin's only, call it $700. So the volatility is a lot less than it was several years ago. Understand, rates have been at this level for 4 years too. Back when, Greenspan took rates from 1 to 5.25, you saw bigger swings.
Right.
In respect to the volatility, as an options trader, that means if you're selling calls, you're going to be able to collect less premium. But, conversely, and why I like buying puts, that's my favorite strategy, is because the volatility has dried up a little, Andrew. You can get more bang for your buck, so to speak, and you can buy. I don't know of another commodity that you can buy an at-the-money option with 2.5 years time with, a 50+% delta for $700-800. You can't do it in corn. You can't do it in natural gas, gold. I don't know of another commodity you can do it for.
It sounds like it has a lot of positive leverage right now due to just the low volatility environment. Now, how long? Okay, just here's we've only had 40 tick range in the last
last
6 months. So the type of range we're looking for clients before they make a little jing on this would be more. You'd probably need at least a good 60 ticks or 80 ticks on the downside for those puts to start to sort of spring to life. Is that fair?
Not necessarily, because you figure if, let's say you have a 50% delta and the market moves, your scenario, let's say 60 ticks, these options should realize half of that move or 30 ticks. And, an option that's $750 and you're paying $800 for. So bang for your buck. That's almost 70-80% on your money on a 60 tick move.
Right. So
it really depends what the investor's expectations are. Ultimately, this 40-point range is tradable, but really to make the trade worthwhile, you're going to need to see rates start to move higher, which I believe there's potential in the next 2-3 years for that scenario to play out.
Right. So we're talking like a 98. We're talking 98 or something like that on the Eurodollar contract. Something along those lines, which would be a pretty big move. Given the
high in the last 6 months, Andrew, is about 99.25, and the low is 98.85, and you're at 99.10 right now. So
you're very stuck in the high end. So you're 15 ticks from the high end of the range, right?
Correct.
Okay.
And that's what makes it attractive to me too, because a lot of clients I talk to trading 30-year bonds, looking for the bond bubble to burst. You're talking a $9,000 move against you if you were to short 30-year bond futures right now just to get to the recent high that we saw a couple weeks ago. In leverage terms, it's $9,000 for one futures contract versus $300 to the contract high in Eurodollars. So if you look at not as much what my reward is, but how much exposure or how much risk I need to take to put myself in that situation.
Right. Okay. And one last thing, could you explain the link between, let's say when money goes as a flight to quality to treasuries, what happens to the Eurodollar? Is that because interest rates go down in the U.S.? What happens exactly to the Eurodollar, and you kind of have that flight to quality to treasury bonds? What happens?
Yes, certainly. Typically speaking, if, hot money, so to speak, or money moves into the treasury complex as a whole, it's going to find its way in all different instruments, from the short end to the long end. If that was to play out, you would see, even without interest rates moving at all, you could see the Eurodollar futures move higher. The highest the front month contract is traded to is about 99.70. So, if we were to see a spike higher, risk move into this instrument, you're still talking of roughly 50, 60 points or $1,500 move against you versus, again, if that was to happen on the long end in 30-year bonds, I would say it's probably closer to $6,000, $7,000, $8,000, $9,000. So what I'm recommending clients to do is not dive in head first and scale into the position. We have clients out in December 15, March 16, June 16, September 16, and I wouldn't go all in the trade. I would start building a position on the expectation of being in the trade for the next couple of years.
Right. Just so it's just like investing in almost anything long term, you're investing in the fact that our rates can't really stay at this level, for the next 2 years, as that's outside the envelope that he's supposedly the great Ben Bernanke is letting us know, but it certainly could work out in the meantime. Things started to spiral a little bit faster than they thought. Thanks, Matt. Thank you for answering the questions.
Hey, Matt, Alex Jacobson, kind of a naive question. How do you keep customers engaged, interested, and looking at this when you're going out 2.5 years on stuff?
Well, I wouldn't put, people that trade with us don't move their entire portfolio into one trade. So it would be one transaction in their account. And, we may be more active trading agriculture or energies or currencies. But, whenever there's activity in the account, they're going to get a statement. And believe you me, Alex, they stay engaged if they're making or losing money. So, it would be a core position. It would not, be a core position in a portfolio. It would be a small sliver in a commodity portfolio. And it's got to be an investor that has a vision that thinks, hey, you know what, I'm going to take a different approach and think outside of the box a little. I do think rates are moving higher sometime in the next couple of years. What's the best way, risk to reward, to play it? And I think, shorting Eurodollar is the best way.
Thanks, Matt.
All right. Well, Matt, that kind of sums up everything that we have for today. Now, I know that you have a newsletter that you send out to people, and maybe they can kind of keep in touch with you. Where can our listeners go to find some more information on that?
Yeah, certainly. If they go to the RCM website, which is just RCM Futures, and look at the news and commentary section or the premium research section, there's a lot of content on a daily basis that I write there. If that's too much, just Google, my name, Matt Bradbard, and you'll see content all over the internet. And all my contact information is there. They'll be able to opt in and get in touch with me about specifics, whether it be this Eurodollar trade or, pick my brain on any other markets that I'm currently trading.
Gotcha. So rcmfutures.com, correct?
Yes, that is correct.
All right. Any other thoughts or anything before we bid farewell?
No, that'll be it. Thanks for having me on. And, if people want to see this, I did last week write a report specifically outlining this Eurodollar trade. Reach out to me or sign up for our premium research, and the report was issued last week on the RCM website.
Wonderful. Thanks for coming on, Matt.
Thanks, guys.
And now let's dive right into the trading block.
The trading block.
And welcome to the trading block. Andrew, what is catching your eye today? That VIX actually went up a little bit today.
Yeah, I think we had a pretty normal weekend, putting the weekend back into the VIX. Mostly the manufacturing report wasn't great. It was just okay. And we had our normal about 0.7 markup in the VIX. So vol was only up a little bit. So I think it was kind of, I don't think anything was too out of the ordinary. But the treasuries, again, that's funny because we'll be talking about Eurodollar soon. But, treasury's still looking kind of strong. I don't think they've really ever recovered from this Cyprus, whatever. I know what didn't make a real big deal as far as the actual dollars went globally, but for some reason it's making the treasuries hang up. So, between volatility at lows, mostly because the market's not moving very much, which is reasonable, and the treasury's kind of hanging tough at a higher level. Those are really the two big things I'm watching. Not really much of a trade yet, but more of a wait and see thing so far.
Alex, what's lighting up your tape over at Options Express today?
Yeah, interesting. Today was Tesla. In fact, Regis sent the chart over to me today. It said, we're lighting up the phones on Tesla. They announced they're actually going to make money this quarter. And, of course, being cynical, as many of us are in this industry, we were scratching our heads trying to figure out if that was an April Fool's joke. But Tesla intraday was up about about $6-7. I think it closed a little bit off that. The other thing that was keeping everybody busy today was Apple. Apple bouncing off the lows. It's taken out the recent low, or it's trading right near the recent low. So Apple had a very difficult day. And to those of you living in Illinois, one interesting piece of news, I know it's kind of not option related, but California judge allowed the city of Stockton to file bankruptcy. And I know it's not mainstream option report kind of stuff, but generally municipalities have challenges with filing bankruptcy. And of course, then the conversation started about the state of Illinois and city of Chicago and what are their long-term probabilities if the courts allow the municipalities to hide behind bankruptcy protection. So some interesting stuff going on today. Was a light volume day. And the stuff that really lit up the phones weren't running hot all day long, mostly in the morning, mostly in the afternoon. But it was a light volume day, and it continues to be a light volume in the options environment right now.
Yeah, the other thing that I found interesting today, the small caps actually went down a bunch more than the large caps. Just by comparison, I have the Russell 2000 down 12 3/4, and then with the S&P, it's only down less than 0.5%. So with that, it's definitely a little bit more. I hate to quote the person I'm about to quote, a little bit more pin action to the downside, so to speak, on the small caps. That's for sure. And then just in looking at things, still with Facebook, that also appears it didn't really have a lot of movement in that one as well. So with that, unless anyone else has anything else to add to the trading block, let's get odd, everybody.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
And welcome to the Odd Block. This is the section of our show where we ship it out to Maine. We outsource all the expert material to the expert himself, the rock lobster, Mr. Andrew Giovinazzi. Andrew, what is odd today?
The rock lobster. I still haven't pulled the Twitter handle of rock lobster yet, or option lobster. I got to do that.
Oh, that's what you need to do, the option lobster.
Yeah, I got to do the option lobster. But a couple of things. Funny is a lot of the big volume was going into looked like some call buying in longer term options, like 2014, 2015, maybe taking advantage of the low volatility. But first we have a PAL, North American Palladium. Yeah, I know this lights up everybody's tape. It's trading $1.75, but it was up 33 cents today from a buck 42 up to 175. So it's a pretty big move for a small stock. Maybe the commodities are lighting up again. You don't know. But the Jan 2014 2 and 3 level calls traded for around 2,600 contracts and 5,700 contracts this morning each. So that's a lot of buyers for a small name that only trades around 920 contracts per day. The price of the options around 30 cents to 15 cents, on the two strikes respectively. So, I would say pretty bullish paper. I didn't know what was going on there. The 10-day implied volatility of the name is very low. It's only like 25 for a $1 3/4 stock. That is basically the stock never moves. So there has been a lot of interest in this name. I was trying to figure out exactly why, but I think people are just getting really long. There was a lot of open interest in these contracts as well. I don't think this paper is closing because that implied volatility actually was going up in January. So in Jan 2014. So, it looks like, a $2 stock that somebody's expecting to go to 3 or 4 over the next year. So it looked like, definitely a reasonable trade. because instead of paying $1, like Alex would always say, just buy the stock. It's $1.75. But people are looking for turning, some dimes and nickels into some doubles is what it looks like. So
now let me ask you this: in both your guys' floor trading experience, how frequently would you work with options on stocks that low?
It basically, usually in a pit, you would have like one stock that was like 18 and went to $1.50 or $2. And it seems like the delisting requirements were a little lighter, I guess, because this has open interest in it. But as I recall, they get down to $1 and they would start delisting the options. So this actually trades a fair amount, 900 contracts a day. So there was usually one in every pit, one or two in every pit somehow, some way, in back then. So I mean, actually a lot of biotechs back then. When I was floor trading more actively.
Love those biotechs that go down like that. They're great for business.
Yeah, exactly. 18 to 2.
What?
We'll do a couple more here. One, and this is a theme I've been watching, and I think it's based around nobody quite knowing what's going to go on when the Obamacare goes through. But I have been seeing. I mean, I know that the healthcare stocks have taken off. The last year, they've made a huge rally. And this is the XLV, which is the Spider Healthcare ETF. It's trading right near its 52-week high. And paper bought a block of the June 45 puts for 77 cents, a little over 8,900 times. So, and this was basically, they did the whole average volume is around 8,000 contracts. So it was, pretty much the daily volume in one print. The open interest was very small in this contract in June. And by the time I posted this, there was actually over 10,000 contracts trading. So I've seen a lot of these where it looks like, and I think it might be a fund that's long a lot of these stocks because the sizes are relatively the same, somewhere between the 7 to 10,000 contract range. And they're buying out of the money puts in like the June cycle, which could be locking in pretty sizable gains in all these things. I mean, I remember the XLV trading like 35 last year at this time. So it's trading 45 now. So, big gains in some of these, and they're just locking in profits, which I believe you called risk management last week in your famous rant, which I think that's gone viral over the internet, by the way.
Okay.
And last one. An old, I hate to bring it up, but I have to bring it up because this is options, the option block. Cisco
was not a friend of mine.
Was not a friend of yours, but it's actually trading real close to a 52-week high again. Earnings are coming out in 6 weeks or so. But a huge buyer of the Jan 2014 18 level calls for $3 and $3.55, 11,000 contracts traded. Cisco does trade a lot. It's still an 80,000 contract a day name. The open interest on the strike was 10,940. So it was hard for me to tell if this customer was actually closing, but the trade was marked spread. So it was a little odd to me. It was marked spread. I could not see the other side of the spread. There was no really countervailing volume against it. When I was looking, the jam volatility was up slightly today, but probably not much more than, it was 0.3 of a volatility point, not huge. So that's basically, that could be the bid offer spread, really. I don't think it was too big. But an interesting thing here is the 30-day implied volatility in Cisco is 19. These actually options traded about a 25 volatility. So, I mean, the vol is very low in there, and this is somebody obviously looking to gain pretty much a straight, this is a good thing, investing with options. You want to get long Cisco, you're only paying $3.50 for the 18 level call. So that intrinsic value there is, the premium plus call is $21.50. So, you're only paying 50 cents more for than where the stock is currently trading, but you only have risk down to $18, and you're getting pretty much all the delta you would have just buying stock. I mean, there were literally 90 delta calls. So, I mean, I think as far as getting long Cisco, this is a good way to do it because you only use a fraction of your bucks if you're going to buy stock. I mean, you literally can buy 4 calls. Actually, it's more like 6 calls for every 100 shares of stock you'd go if you just did it all cash secured. So you get cash secured, so you get 6-to-1 leverage buying the option over the stock with the same dollar for dollar risk. So an interesting trade. It just looks to me like somebody's getting long, basically.
Yeah, the beauty of buying a deep and in the money a 90 delta call like that is the fact that if you're not looking to lever yourself, keep the rest of the money in cash. If you were normally going to buy 100 shares of it, you can perhaps consider buying that call option instead of that. Keep the rest of your powder dry.
Absolutely.
Andrew and Mike, both, could you take a minute and comment about why a trade would be marked spread and how that changes the character of how it's handled?
Sure. Well, depending on, like, a trade of this size is probably handled by a floor broker or more hands-on some way on a floor, or going through where a trade, once you're trading 9 or 10,000 contracts, generally that is a trade that's going to be matched, or somebody's going to find the other side. It's hard to kind of just jam 11,000 contracts into the system and get filled. So normally when you market spread, you should get a little bit better of a fill, or if the trade's a spread, because it's a lot easier for the liquidity providers to digest a spread trade. So you generally get better prices on both the bid and the offer side. My trouble I have with this one is trying to figure out where the volume was in the spread. I just didn't see any other volume going up, and I looked pretty hard on it. So that's my take on that as far as the spread goes.
An investor doing a spread or rolling a position benefits from marking the trade spread?
Normally, yeah, because you get both sides filled at a better price. Also, the delta on a spread is generally less, so that's always going to be less market risk for a liquidity provider to take.
Yeah, one other point also on a spread trade, on some of the venues, a spread can touch the book and trade at the book price to get the spread done and not take out the book. I know that's something that customers clearly misunderstand, and it'll frustrate them. You know, they'll see something trade at 85 cents and they've got a limit that's been sitting on the book at 85 cents, and they'll see it marked as a spread. It's not uniform across all exchanges, but on some of the venues, you can touch the book for a spread. To your point, though, if you can't see the other side of the spread here, kind of wonder what was going on.
Exactly, which makes it ideal for the odd block. Could not quite see the other. I didn't see any volume even close to the contracts that went up for this. So I don't know if it was against stock. Maybe it was a stock replacement, possibly. I don't know why they would market spread, not buy right. But anyway, that's what had come across the tape when I was looking at it. So it just made it an interesting trade to bring up. And, of course, anytime there's something interesting in Cisco that I see, I must at least mention it, once every quarter. Once a quarter is enough.
Got to fill your quota. On that note, that will do it for today's edition of the Odd Block. Now let's dive into the Express Block.
The Express Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
And welcome to the Express Block, or since it's my show today, I'm going to call it what I want to call it, the Viceroy Block. This is where we're going to sit back and listen to the wise teachings and wise thoughts from Options Express from the Viceroy himself, Mr. Alex Jacobson. Alex, the floor is yours.
Thanks, Mike. As I mentioned, the two things that had the phones going early in the trading day and again late in the trading day were Tesla and Apple. Tesla with a big move today, a $6 move, releasing the expectation that they would make money next quarter. And again, I know this sounds redundant, but some of us scratched our heads and said, "Is that an April Fool's joke? Is Elon Musk that clever?" I don't think that's the case. Although there was a great April Fool's joke running around the internet last night. The folks at Google and YouTube had announced that they were going to shut down YouTube because they had enough videos, and it was originally opened as a contest, but it was clear that was an April Fool's joke. The other thing that was interesting today that kind of was curious is we got some numbers of the first few months of trading of the weeklies on futures options. And they appear to be a resounding success. So I know weeklies have been around for a while, but we're finally starting to see some real traction amongst the customer base for weeklies on futures. The most active was the crude contract. Gas also was active because gas has obviously had a big move lately. But it's interesting and it's good to see futures trading, futures options getting the kind of traction the options industry would like to see. I know one question that comes up a lot is how are minis doing? And minis are plodding along. They seem to be doing okay. There's certainly a lot of tire kicking going on in minis, especially in Apple. That's where most of the traction seems to be in the minis. But minis are getting interest, and they're getting a lot of press, and there's a decent amount of activity in the mini community.
Now, it's interesting you had mentioned that the minis and the futures options. What are some of the other futures options that have the weekly contracts? Does the S&P have weeklies, for example, or does the 10-year note, or what are some of the other popular futures weekly contracts besides crude?
Yeah, good question. The E-minis have it. Essentially all the liquid contracts, even all the way down to NASDAQ, have got weeklies, but the traction has been mostly between crude and nat gas, and then it's been the E-minis. It's been, speaking of futures, it's been the euro rate has been really active, but again, that's a very deep liquid contract. After that, it drops off a bit, but most of the traction has been exactly where you'd think. It's been energies. Gold does a decent amount of weeklies, but the S&P 500 E-mini does almost as many weeklies as crude does. So the top 4 or 5 have been those.
Okay. And are the weeklies similar to how the newer weeklies are on the security side of it? So, for example, you can do a 1 week, 2 week, 3 week, 4 week, and 5 week option, or are they like they used to be with, or like a lot of the weeklies with 1 week and then go right into a month?
So there are multiple weeklies, but it's not uniform across products. It used to say it's not uniform across exchanges, but there are only 2 real futures exchanges left as kind of the umbrellas for everything that trades. But it's not uniform across contracts, but you generally have a first, a second, and then the traditional month, and then a first and a second going into the next month.
Got it. Well, good. Well, Alex, thank you for the Xpress Block. And now let's dive into Around the Block.
Around the Block.
And welcome to Around the Block, everybody. This is when we look into our proverbial crystal balls to tell the folks out there in our listener land what we are looking at and what we are trying to see what's going on in the upcoming markets. Andrew, I will go ahead and start with you. What are you guys looking at over at the pit?
At the pit, well, we're looking at, funny of all things, like BlackBerry. It seemed to come back a little bit from the earnings. On Thursday, obviously, we looked at Apple a little bit. On Friday, we actually closed a long straddle we had there. Could have waited, could have been a home run waiting another day, but I'm not going to begrudge making any dough on it. Lastly, I just watching volatility go up into the non-farm payroll. I mean, vol is relatively, just from an absolute perspective, not very expensive, and I'm just curious to see if people bid it up into the non-farm payrolls again, like they've kind of done as a pattern every month for about the last 8 months or so. So we'll see if it continues today. Monday's usually a tough day to want to sell any kind of vol. So and that's it. But it's kind of flat. I mean, we don't have a lot going on in general. Just kind of watching to see if the market can pick some sort of direction from here right now.
Alex, over at Options Express, what are you guys taking a look at?
Much like Andrew, with quiet markets, and really what's driving stuff lately has been events. Seeing decent premium selling again, even though vol has moderated. The premium harvesting portion of Hub is getting a lot of hits, and what was lighting up there today was credit spreads on both the Russell and the SPX PM. But it's been light trading, so things have been somewhat quiet here as of late.
Got it. Now, what do we have coming up at the Option Pit? Andrew, what big events do we have? Longo let me borrow his birds this week, and I hear the birdies are telling me that you guys have something going on Thursday night with a well-respected investment advisory.
Yes, I do believe we have an investment with RCM Capital. That's Mark. Of course, it's still not on our website. I was looking for it right now, and I still can't see it on my login for whatever reason. But Mark, I believe he's there on Thursday night, right?
That is correct. We have Mark Sebastian coming on as our guest speaker this week on TNT Thursday Night Trading. We're excited to have him.
So he is excited as well. I'll be honest, he's on his way back from Detroit tomorrow morning. So he should be there in plenty of time. And yeah, we're looking forward to it. That's always it's a really well attended event. So
yeah, we always get a big turnout whenever we have the Seabass coming to town.
We do. He is entertaining, and he actually knows something about options as well. I know it's crazy, but it's true.
It's a weird thing.
It's a weird thing.
Alex, what do we got coming on at Options Express?
It's IRA season. So the webinar calendar is fairly target rich. Minis, we're doing minis at 2 p.m. Central on the 3rd on Wednesday. That's especially targeted at accounts that want to hedge or overwrite and don't have the full 100 share round lot. And then on Thursday, 2 p.m., we're doing an IRA collars presentation. I know a theme near and dear to your heart, Mike, but
very much so.
It's the last rush here to IRA SEP season. So a lot of it is focused on what you can do in retirement accounts coming into the April 15th deadline.
Sounds good. Well, as always, everyone, we'd like to thank everyone for listening. Thank you, Andrew. Thank you, Alex, for being on the show today. And we'd just like to remind everyone that we will be back at it later on this week. Mark Longo will not be here later this week, but we will have another pretty good host for the show, Mr. Mark Sebastian. We're excited about having him host the show again. I'll be here as will the rest of the cast of characters. So make sure you tune in later this week. On that note, I'd like to thank everyone for coming, wish everybody well, and folks, let's have a successful trading week this week. And by the way, the Apple thing about being 220, it was another April Fool's thing I couldn't resist, in case you were wondering. Have a great day, everybody.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated, all rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.